Today, we're going to be reviewing some live rates and going into our deep dive topic of short-term rental DSCR loans. One of our favorite topics here at the Mortgage Calculator. In the meantime, we put the chat up on the screen. We'll wait just a couple of minutes to get started here, but the chat is up on the screen, so you can drop a comment in there as we wait to go live on all the different platforms here. Thank you for tuning in nice and early. We appreciate it. And we'll get started here in just a moment. I hope everyone had a great weekend. Ready to get back to it here on Monday. Thank you for the comments coming in. We appreciate it. Owen, Jason, thank you. We'll get started here shortly. Great topic for today, one of our favorites. All right, Warren, thank you for the comment. Appreciate it. All right, it looks like we are live on all the different platforms, so we can go ahead and get started here. We'll take the chat off the screen, but please keep dropping comments in the chat as you tune in, and feel free to drop any questions about our deep dive topic as well. Welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. Every morning at 11 a.m. Eastern, we go through live mortgage rates for different programs, and then we do a deep dive into a different loan program. And today's deep dive is going to be short-term rental DSCR loans. This is one of our most popular products here at the Mortgage Calculator. So our sales manager, Jose Gonzalez, with 28 years of experience as a loan officer and a realtor, is going to go over an in-depth overview of short-term rental DSCR loans. But before we do that, we'll do what we do every morning here, which is go through some live mortgage rates. So Nick, if you're ready, let's pull up our pricing tool and we'll see what the rates are looking like this morning.
All right, let me switch my screen. And we will check it out. So this is our pricing tool for our team of mortgage professionals. If you'd like a full breakdown of the APR, which we're about to check out here, please get with our team members. We have over 400 licensed loan officers in 24 states. But this tool will show us the general rates and the APR for today. It is September 25th, just after 11 a.m. Eastern. So all of our standard programs have rates issued for today. So in order to compare across the programs, we'll set up a scenario that will be exactly the same so we can compare apples to apples on the APR. So we'll set a loan amount of $400,000. We'll set an LTV of 80% loan, 20% down payment. We'll set a desired price of $99. That means we'll ask the computer to find the best rate at one discount point cost. And we'll check out our different options. We'll check out conforming conventional first, then we'll go into FHA, and then we'll check out our expanded guidelines, also known as non-QM, where we have over 5,000 additional options. We also offer VA and USDA. VA is only for eligible vets and active service members. If you are eligible, let us know. We can quote it in a couple clicks. And same with USDA. That's only for properties that are eligible. So if you do happen to be shopping in one of those areas, let us know. We can still quote that up. We'll start today with conforming conventional. We'll do a purchase, 30-year fixed loan, primary occupancy, single-family home, 1 unit, state of Florida, county of Miami-Dade. And for all the demos, we use an estimated FICO score of 760. And an estimated debt-to-income ratio of 40. So with all these basic settings, let's check out the conventional options this morning. All right, some lower action here at the top. A little bit of a fluke there. 7% rate, high discount points, but our APR comes in quite a bit lower. So 7% rate, 2.875 discount points. Final APR of 7.229, but looks like the more standard options here, 7.5 rate for 0.75 discount points and cost. Final APR around 7.658. So these are some good options for our customers that qualify conventional. Typically, if a customer doesn't qualify for a conventional program, the next one we want to check out is an FHA. FHA does allow a little more leniency on credit items, as well as a much higher debt to income ratio we can utilize. However, we'll keep everything exactly the same so we can compare the programs apples to apples here. All right, FHA went up a little bit from last week. It looks like here 6.75 rate, 0.685 points in cost, puts the final APR at 7.332 when you add in the upfront and yearly mortgage insurance. So you see here it's actually a little bit cheaper than FHA, about 0.3 cheaper in most examples. So our customers that qualify for both, definitely check it out. And our customers that need to use FHA, definitely some good changes here and some good options. Now, where we love to specialize at the mortgage calculator is if our customer doesn't qualify for either. Fortunately, most other banks or lenders will have to deny that customer, but that's where we come in with our 5,000 additional loan programs under expanded guidelines, aka non-QM. So we'll keep everything else the same, but now we have a new option that pops up, and that's our income. So we can change the income we use when we use a non-QM program. So full doc is what we use for FHA and conventional. That's 2 years of tax returns. So we would typically choose a non-QM option to take advantage of one of these alternates, such as our asset programs, business bank statement programs. Our investor programs are only for investment properties. We'll show that in a minute. Personal bank statement, 12-month. This is our most popular program by far. That's what we'll use for the demo. And we also have RSU, stated, BOE, 1099, P&L, no income CDFI, all kinds of options. However, the personal bank statement 12-month is the most popular, and that's for our self-employed borrowers. Many times our self-employed borrowers, when they submit 2 years of tax returns, will have different write-offs and may not qualify at all, or just maybe a little bit short of getting the income that they need to get the house they really want. So we will solve that problem for our borrowers with a non-QM program. No tax returns involved at all. Simply use their last 12 bank statements for income, and we'll determine a debt to income ratio of 40% in this example, using no tax returns at all, just the cash on the last 12 bank statements to determine this DTI ratio. So with these basic settings, let's check out the bank statement programs this morning. Ooh, right there. So the option that always pops up at the top here, 7.5 rate, 3.375 discount points at cost. So it's pretty hefty cost, but this magic combination is at 7.646, which is actually equal or I think a touch cheaper than most of those conventional programs we saw this morning. So again, as conventional goes a little bit crazy, non-QM becomes even more viable. So I think we're actually beating it this morning by a hair, but you'll see we're right there in the mix. So our customers that need that extra help for that bank statement program to get that income they need, definitely check out the non-QM programs. They're almost identical in cost and can obviously solve a lot of problems for our borrowers. Now, if you scroll down here, you'll see there are a bunch of other options, a little bit higher rates and costs. Some of these may allow bankruptcies and foreclosures and other types of events that would cause us to otherwise not qualify. So not only can we use alternative income here with these hundreds of programs, we can also get around other guideline issues. So please get with our team. They can find the best one. Now, we're going to do a deep dive on investment properties with Jose, but we always want to do our live pricing for our general examples first. So I'll do our last two live pricing demos for investment property. We'll set the LTV to 80% loan, 20% down payment, just like before. And we'll compare our investment property options. We only have two. We can do conventional conforming options as well as non-QM options. Remember, government programs, FHA, VA, and USDA are not for investment properties. So we'll select conforming conventional first. Everything's going to stay exactly the same as all our demos. All we've edited is the occupancy. So we can see the adjustments that the conventional programs have added for investments. Yeah, this one program is giving us a little bit of a fluke. We can't really use that. So let's focus in on this one, which is still a little expensive. 7.625 rate for 3.25 discount points and costs. Final APR of 7.867. So I'd say this is the best option for conventional. With the conventional rates the way they are, we're even getting some weird stuff showing up here. So conventional rates for investment properties, just not realistic right now. Definitely recommend our customers that are looking at investment properties, check out the non-QM options. So let's go into those. We'll set investment 80 LTV again. And this time we'll go to expanded guidelines, aka non-QM. And the first thing we need to select is our income. The most popular for an investment property is our investor DSCR program because it doesn't require any income or employment from a borrower. Simply use the estimated rental income from the property to determine a DSCR ratio. It stands for debt service coverage ratio. If the estimated rents can cover the PITIA of the mortgage, aka the property cash flows monthly, the ratio is 1.0 or higher. If the property does not cash flow monthly, that's a ratio under 1.0. We still have options for those as well. For the demo, we always put 1.5 since that's the highest option. That way we can see all the different loan programs pop up. And the final thing is a prepayment penalty. This must be set on any non-QM investment property. 3 years is standard. We can choose no prepayment. That will cost more and limit the amount of loan programs that show up. And 5 years can be selected as well, but we'll limit the loan programs that show up. If they do show up, they will save our borrower a little bit of money in that case. But the most common is 3 years. That's what we use for all our demos. So let's check out the DSCR options this morning. Best option at the top here, 8.125 rate, 0.85 discount points and costs, puts our final APR 8.187. So a good option here for our customers. Remember, conventional, there was, I think, just one option in the 7 APR. All the rest were in the 8. So again, conventional, almost identical to non-QM. So I'd say 90 plus, maybe 99% of investors right now, when they're presented with a non-QM or DSCR option compared to a conventional, are going to choose a non-QM option. So definitely recommend all our investors out there, check out these programs. Some of these options at a little bit higher rates and costs may allow bankruptcies, foreclosures, other guideline issues. And some of these programs at a little bit higher rates and costs may allow things like short-term rental income, which is our topic for today. So let me go ahead and switch my screen and we'll get ready for Jose's deep dive. So we do live pricing every day for our DSCR programs. Those are all our standard programs. Not all of them, as I say every day, allow short-term rental income. Not all of them allow us to get around the foreclosures and bankruptcies, but some do. So today, Jose is going to go through those DSCR programs that you see every day on the list, the ones that do allow us to use short-term rental income or be worked around in a way where we can do a short-term rental property. So there's two different things I'm sure Jose is going to explain. Using short-term rental income is one method, but if we can make it work without necessarily using that, there's still another way to do it. And there's multiple methods of short-term rental income. So I'm sure he has a few different examples for you here. So Jose, if you want to explain a little bit, let's go ahead and check out the examples when you're ready.
Good morning, everybody. Thank you for joining us for Daily Rates Live with the Mortgage Calculator. Great to be with you this morning. Our debt service coverage ratio program is a great option for the investors because it offers much flexibility when reviewing how the income is generated by the property. First and foremost, it's a great option because our investor is not required to have a job. We don't have to verify any personal income from the investor, nor do we have to verify employments. Hence, we don't need tax returns, W-2s, pay stubs, anything like that. The debt service coverage ratio is basically determined by dividing the gross rental income generated by the property divided by the housing expense, principal, interest, taxes, and insurance, and if applicable, association fee. So that is where this program gets very interesting because it is exactly in the flexibility that we have on how we reach the gross rental income that makes the DSCR program so special. Because besides allowing us to use long-term rent, whether it is an occupied property or whether it is a vacant property, the program also allows us to use various forms of short-term rental income generation. We can use either AirDNA, which is an estimated short-term rental income, which is obtained from databases that have short-term rental income information. Right? Similar as the appraiser would go into the MLS to look up long-term rents comps. you could go, or underwriting could go, or the appraiser could go into AirDNA and could locate short-term rental comps with the same requirements that they would need to follow for long-term rental comps. Has to be similar gross living area, similar style, the location. It can't be like 10 miles away each comp just because you were looking for the perfect comp. It has to fit certain requirements, and usually proximity to the subject and the similar style and similar gross living area are the three most important items to consider. And obviously, the subject property, if you're using AirDNA, also needs to already be a short-term rental type property. So DSCR does allow us then to explore different options for that. So either AirDNA or short-term rental revenue reports uh, from activity generated in some of the platforms like Airbnb, VRBO, HomeAway, and whichever other platform that you have. The short-term revenue rent reports would have to be provided for the last 12 months. Short-term rental revenue reports can be provided either by the seller of the property, if it's a purchase, or they can be provided by the borrower if they have been doing short-term rentals for the property for the past 12 months. Okay, so our first option here is the option that would allow us the highest LTV while using short-term rental income. Uh, Typically, I wouldn't say typically, but you do face a scenario when using short-term rental income, depending which option you're selecting, of a potential either a 5% LTV reduction or a maximum LTV that is possible under that program option, whichever you may be considering when using short term rental income. So that is why it's so important. You review the guidelines carefully to see if there is any type of an LTV adjustment or LTV limitation when using short term rental. So in this scenario here, this is a scenario where we will be able to obtain the highest loan to value while using AirDNA comps. Now, AirDNA is the most favorable one when trying to capture the greatest income because you do not have to rely on short-term revenue rental reports that may not be available. So in this case, however, there is a 5% LTV hit. So this option, which is normally an 85% LTV DSCR loan, then with the 5% LTV adjustment would be an 80% loan using AirDNA, which is going to be the maximum for AirDNA because in every other example that is an 80% loan max, there's going to be either a 5% adjustment or a 75% max LTV when using AirDNA. So keep in mind, this is the 85% LTV rates. So just because they drop it to 80% doesn't mean that you're going to get a better rate. They're going to hit you with the 85% rate. So here you're looking at 9.75 being your lowest cost option, and you can buy it down to 8.75%. And again, the benefit to this option is if you absolutely want to or need to, for whatever reason, use AirDNA because you want to get 80% LTV, short-term rental revenue reports may not be available or just won't do it for you, this would be the option for max LTV. Now, similar LTV here now, but this one would be using short-term rental revenue reports, 12 months worth. Now, if you have a seller that is currently doing short-term rental and would provide these reports, that would be obviously the best case scenario. And the only way this would be possible if it was a purchase where the borrower obviously has not been the owner of the property. But you do note here now how the rates are substantially better, right? This is for standard DSCR, no adjustments. This particular option lets us use the short-term rental revenue reports at the max LTV. So you're looking at 8.25 actually with a little bit of a lender credit. And you can buy it down all the way to 7.375. So again, you can see the big benefit to using the revenue reports when the seller provides the information on a purchase. So now this is another AirDNA example. So the benefit for this AirDNA example, it's only 75% LTV because it's the 80% rate, but then you get a 5% haircut. Is that the difference with this one is if your borrower wants better rates. Obviously, you can see here 8.99, a little bit of a lender credit, and you can buy it down to 7.625. Now, we have some other methods with DSCR that we can attain the goal when we have that short-term rental type property. Now, in this example, where you may not have short-term rental revenue reports available from the seller, or you may have a property where AirDNA comps are just not available. Maybe the property also has not been listed previously on for short-term rental, which then would not allow AirDNA either. We have our no ratio DSCR loan. This is the loan where the property does not even have to cash flow at a 1.0. In this scenario here, we're talking about 0.75 to 0.99 DSCR with 25% down payment. You could reach that same goal as if you were using the AirDNA properties and going through all of that. So you're looking at a slightly higher rate as in your lowest cost option, 9.375, but you can buy it down pretty much. Let's see here what we were. Yep, it's not much of a difference. 7.625 there versus 7.875 here as your lowest rate option using the 0.75 to 0.99. Now, if you have that amazing trophy property, just got to have it. Maybe there's no long-term rents that support, obviously, no short-term rents, but your investor knows that they're going to make it happen. They've done it already in a couple of properties like this. Well, then you can use your short-term your no ratio less than 0.75. So here the property does not even cash flow above 0.75 DSCR. Still, you're looking very good options here. Again, 75%, and you're looking at 9.75 as your lowest cost option, 9% lowest rate option. Obviously, a little bit more expensive with this option, but this is a true as low as 0 DSCR. So now with a couple of refi cash out options. Again, this one we're using short-term rental revenue reports. Keep in mind for a cash out, AirDNA is not applicable. It's not applicable obviously for any refinance options. AirDNA is strictly for purchases only. So in this option here at a 75%, you're looking at 8.375, a little bit of a lender credit, and 7.375 lowest cost options. This is for a 1 unit. And then as always, we like to help show some examples here for our house hackers out there. This is our 2 to 4 unit, same option. 75% LTV using short-term rental revenue reports. Little bit of adjustment, almost a 1 point adjustment for the 2 to 4 unit. with 8.875 being your lowest cost option, and you can buy that down to 7.75%. So we have quite a few options here for our DSCR investors looking to purchase that short-term rental property, either a 1 unit, 2 to 4 unit, and we can take it all the way up to 80% LTV. Now, should the property cash flow on a long-term basis, there would be, obviously no reason to go through any of these exercises. We would just go with the 85% loan to value option and take it from there.
All right, great. Awesome programs there. I don't see any questions, so we can wrap it up. Remember, we do this 11 a.m. Eastern every single weekday where we go through the live rates and then do a different topic every day. So we will be right back here tomorrow with a new topic. Thank you, Nick. Thank you, Jose. Thank you, everyone, for tuning in. And we'll see you tomorrow, 11 a.m. Eastern, for the next episode of Daily Rates Live with the Mortgage Calculator. Have a great day, everyone.
Thanks, everybody.
Thank you, everybody. Have a great day.